Hello, everybody. It's Hammer with your weekly mortgage market update here at Vetted VA. Let me go ahead and share my screen. Got a little overzealous trying to get the technology set up this morning. And there we go. So today's mortgage market update, and our guest today is the lovely Veale. Is that how you pronounce it? Is it Veale like the cow? Or is it Veale? How do you pronounce it?
Yeah, it's so funny. I get asked that so often. It's the E on the end that throws everybody off. It is just veal, like the baby cow.
Yep. Okay, then there you go. So thank you for joining me, Gay. Please tell everybody a little bit about yourself.
Yeah, so my name is Veale. I'm a VVA4 here with Vetted VA. I am a loan officer. I work for Epic Lending. I am physically located in the state of Colorado, but I'm licensed in 11 states. I won't run through them all, but the big ones are Alaska, Colorado, Virginia, Texas, Florida.
What's funny, I try to point out to mortgage professionals, any of y'all out there that are in our vetted community, please tell your professionals you don't know that they even have to be licensed. So you didn't know they couldn't do business in all 50 states. So we, as professionals, we talk about where we're licensed because we know how important that is. But for most people out there, they're like, oh, you mean you can't just write loans in Kansas? Oh, I thought anybody could write loans in Kansas,
Yeah.
It's kind of funny how we do that. So remember, if you are here live, do us a favor. Let us know that you're here. Say hello, say hi to Gay and welcome her. Be a part of the conversation. Ask us questions, share your thoughts, and let's talk about what's going on with your world. Feel free to ask individual questions about your scenario. We'll be glad to answer them for you. I know that many of you aren't able to make it live, though. So if you are watching on the replay, do us a favor and let us know that you did watch. Give us a hashtag replay. We do monitor the post as well. So go ahead and ask any questions or share your thoughts. But please, the more you guys participate, the better these conversations get. So we certainly love to have you guys on there. And with that said, let's pull it up and kind of start out with the real easy. Gay, let's talk about what's happened to rates since last week. So last week, we do these every Wednesday. Last week, rates have been creeping up. And we were basically, when we, I had Joy, I think last week I had Cameron on, and we were talking about, where rates were headed from there. And where do you think from last week, have you seen rates go higher, lower? Where have you seen rates move?
Yeah. So from last week, we've started to creep back up again. We had a little bit of a rebound at the beginning of the week. And then, sure enough, we start creeping back up again. And, I'll tell you, like when I have clients ask me about rates, that's at this point in the year, listen, they're so unpredictable right now. I'm just like, let's lock and protect the rate that we have right now today, because you just don't know what's going to happen tomorrow. Even when you think that, you have something that's coming up in the news that's going to affect rates in a positive way, meaning that, they're going to drop a bit. It just seems like we've been disproved so many times this, in the past several months, really, not just week, but yeah, it's been a rough year for sure.
I support that statement 1,000%, because just a couple months ago, I assured everybody, don't worry, rates in the sevens, she's posh. We're not going to see anything like that. And here's why. And then here we are talking about rates in the sevens, and everyone's like, Hammer, what was up with that no rates in the sevens thing? And, again, it was really based on the conditions that we were at just a couple months ago, the end of July. We were looking at rates that were actually improving, and many VA rates were back in the fours, or if not, they were in the low fives. Conventional mortgage rates, meaning if you're not getting a VA mortgage for some reason and you're just getting a conventional Fannie Mae, Freddie Mac mortgage, those were in the low fives. And it was like, okay, smooth sailing. We should see rates settle in between 5.25, 5.75. And a few months ago, we were looking at the idea that the economy was slowing down and that we were going to be getting into a recession towards the end of 2022, early 2023. And when I say recession, I'm talking about the real roll up your sleeves, dirty, we're not spending money, unfortunately, people are losing jobs type recession. I'm not talking about the 2 negative quarters of GDP growth. For those of you that may be, more financially literate, that's a technical definition, what some people will use to define a recession. But and technically, we've had 2 negative quarters of GDP growth. But we're not really in a recession. And over the last few months, we've seen a lot of the economic data has shown just how resilient the economy is. And for those of you not really aware, the US economy is largely driven by our own consumer spending. And Gay, I just went out to Vegas. Were you at Fuse by chance, the mortgage event in Vegas?
Yes, I was.
Okay, so I was right up the road. You did not see me at Fuse. You guys were at Paris, the Hotel Paris. I was up at the Mirage. I had this trip planned with some friends, my wife and another couple, and we went and saw an Aerosmith concert and Cirque du Soleil. And so I was playing tourist while right up the road, all of my mortgage friends were right there, but I couldn't come visit everybody because I was committed to personal plans that weekend. But when you were there, did you see? Was it a ghost town? Were people not spending money? Was the airplane empty? Was the airport empty?
Absolutely not.
Yeah.
No, it was packed.
Yeah. And everybody, if you really want to look at what's going to happen with mortgage rates, just look outside your front door. And that's what you want to be looking at. Are people out there spending money? Because when people are spending money, what's happening is that's going to contribute to inflation, which we're going to talk about in a minute, by the way, because tomorrow we get a CPI inflation report that we want to circle back on. But when we see people spending money, the economy is still resilient and doing well, and the Fed is going to continue to raise rates. And let me throw the chart back up on for everybody, or the little screen here. We've talked about this before, but when the Fed raises rates, come on, catch up. Why is it not? Oh, there it goes. Okay, so when the Fed raises rates, it doesn't directly. So I'm going to write not directly. So it doesn't directly raise mortgage rates. In other words, the Fed has a meeting. I think it's November 2nd is the next announcement. And the Fed is going to raise the Fed funds rate, their policy rate. And it's called the Fed funds rate. And they're going to raise that rate by 3/4 of a point. Now, you're not going to see mortgage rates jump up that day, 3/4 of a point. But as the Fed is raising this policy rate, which was zero through COVID, they had it at zero. They were stimulating the economy. And now they've been raising it because what they're really doing is applying the brakes harder and harder to slow down the economy, which will help slow down inflation. And they've raised it from March and May and June and July and September. And they've raised it at all these meetings. And that's what's driving mortgage rates up. And it's the forecast, it's speculation. Everybody looks at and says, what is the Fed going to raise rates in the next upcoming meetings? And if I bounce around here, these are called Fed futures. All right, this little chart here, these are Fed futures. And what happens is we're looking at what are markets pricing in. In other words, your mortgage rates, they're anticipating that the Fed is going to raise the Fed funds rate, which is currently at 3%, to 3.75. There's a few people that believe, hey, we may only see a 0.5% increase. Most people believe we're going to see a 0.75% increase. This has already been worked into your mortgage rates. So when this happens, we're not going to see mortgage rates jump up. But what we're looking at is what happens later. What happens in December? What happens in February, March, May, June, into next year? And as the economy is doing well, the forecast is that the Fed is going to have to raise rates up here to 4.25. And then by March, we're looking at 4.5. Some people believe maybe even 4.75. And there's now an outlier expectation that we could see the Fed raise this Fed funds rate up to 5%. Now, just a couple of months ago, when mortgage rates were much lower, the idea was that the Fed was going to be able to slow down around 3.75. So we've seen, as we look at this Fed funds rate, that's what we use to forecast. Why do we think mortgage rates are going to move up from here? And why, like Gay said, why is now such an important time to lock, even though these rates are bad? I think that the biggest thing that people are going through right now is fear of missing out. They don't want to miss out on lower rates. And nobody wants to buy a house with the highest interest rate. Nobody wants to buy a house when house prices are going down. Gay, do you think house prices are going down, and why or why not?
I wouldn't say they're going down yet. Like I said, I'm licensed in 11 states, so I get to see, a lot of different markets. And I wouldn't say that I've seen prices or valuations going down. What I have seen is a slow in the appreciation. So instead of having these massive appreciation numbers that quite frankly are unsustainable and unrealistic, now we're seeing, more realistic appreciation numbers, in the single digits as opposed to double digits that we were seeing last year and even earlier this year.
Yeah. So right now we're talking about deceleration versus depreciation. And in the past market, what happens is when interest rates, let's pretend that we have a little fulcrum here, and this is called affordability. All right. So this is what everyone says, hey, I can afford to go get a mortgage. If rates go down, if rates are over here, generally what happens is on that affordability fulcrum, you're going to see prices go up. And that's normally what we've seen. It's what we saw. Gabe, would you agree that's definitely what we saw during COVID?
100%.
All right. Now let's go ahead and draw page 2 here, though, and say, okay, Hammer, so rates have gone up. So doesn't that mean prices are going to go down? And here's where we have to kind of say the word normal, right? Normal. We had a saying when I was a kid. Normal is a setting on the dryer. For those of you that grew up with doing the wash, normal is a setting on the dryer. That's about all normal ever actually is, because normally this would happen, but we're not necessarily seeing this happen right now. And there's a very unique reason this isn't happening. Gay, do you want to take a stab at why prices are not dropping even though rates have gone up?
My guess, the non-expert guess, would be that it's because there's still a housing shortage out there. That's what I would say is so, while we don't have all of the crazy like shoppers out there trying to, grab at an investment property with the lowest rate, that's quelled some of that, but there still is absolutely a housing shortage. And so there's still, the supply and demand is still there. Normal way that you would see. That's my guess.
And that, well, you're 100% correct. And if we want to dig a little bit deeper, we're actually seeing this unique scenario right now. Let me just pull up a different little tool on my drawing pad here, and we'll do a marker. What we're seeing right now is we're actually seeing this weird fulcrum that looks like this, and it's broken. And the reason that we're seeing that is, as you pointed out, it's absolutely because of inventory. And inventory, it's supply and demand. I wrote inventory, but you guys get the point. It's inventory, right? So inventory. And what makes it so unique right now is so many people have mortgages in the 2s or the 3s, maybe the 4s, and they're not going to sell their house and move up when they have a new child, or get something bigger when they get a job, job improvement or something changes in their life. Whereas normally that's part of the regular ebb and flow of the housing market. Is we have people that are first time buyers. We have what we call move up buyers. Well, people aren't moving up or moving across right now, because to go from a mortgage with 2.5 or 3.5% interest to a mortgage with a 7% interest rate, that's a huge difference in payment. And a small difference in payment, we all don't mind, right? We can make that sacrifice. But when we're talking about this large increase in payment, people just aren't moving out of those houses now. So because of people not moving, because we've been experiencing an inventory shortage for years as it is, even though rates have gone up and the buyer pool has dwindled, it hasn't gone down enough to really push prices down, but they have stabilized, and we've seen deceleration. And in your markets where you mentioned being licensed, Gay, have you seen more behavior? Like, for those people that have watched the show in the past, we've talked about seller concessions, things like that. Are you seeing any of that in your markets?
Yes, a lot of my markets have them. Not all of them, to be fair, but I'll give you an example. The last 2 loans VA loans in particular, that I closed in Colorado, one of them had 10,000 in seller concessions and one had 13,000 in seller concessions. So not only was the closing costs covered, but the buyer was also able to get a little bit of an interest rate reduction by a buy down. And they were able to get their earnest money refunded. In some of my markets, it's pretty significant. In others, like Alaska, it's not quite as significant. I'm not seeing those as common there. But again, that's very market driven. But I would say the majority of the markets that I'm in are seeing seller credits right now, or seller concessions.
Right. And I want to put this up on the board just so people can kind of go follow along. We've talked about this in the past. This is a purely a purely fictitious example. This is not an offer to lend. We have to say those kinds of things because of compliance rules and regulations. But if we had an average borrower with, let's say, a 680 FICO score and a $350,000 loan, and they're getting a VA loan, again, just as a reference point, these are not today's rates. If somebody was getting a 6.5% rate, we call that par, meaning they don't have to bring any money to the table to get that interest rate, and they don't have to, they're not going to get a credit back for choosing that interest rate. But you can actually improve the interest rate if you pay money towards it, like we've talked about before, called paying points. So you may be able to take that interest rate from 6.5 down to 6.375 or 6.25. And where that money may come from, it can come from the seller side. So instead of negotiating the price of the home to be $5,000 cheaper, you can negotiate with the seller to maybe pay towards your closing costs or pay towards your loan fees and bring that loan down. And then we've also talked, and again, this is something you want to talk about specifically with your mortgage professional. My advice, find a vetted VA professional in your area, and you can do that at vettedva.com. And we have different things that may or may not be a good plan for you, like what's called a 2-1 buy down. Some mortgage professionals, very big proponents of this tactic. Some are against it. Some, if it's coming from money out of your pocket, it may not make sense. But if its seller is contributing and paying for this, what this can do is help take that first year interest rate. And instead of getting 6.5%, which is what you would qualify for, you need to be able to show that you can afford the house at the full interest rate. But maybe for that first year, you're getting 4.5%. And the second year, you're getting 5.5%. And the reason that this may be an option for you and may be popular is if you're only paying 4.5% interest for the first year, and that money came from a seller contribution, then that may set you up for later on for an Earl. And we've talked about an Earl before. Would you mind just tell everybody, Gabe, what an Earl is and why it's so great for vets?
Yeah, so an Earl is an interest rate reduction refinance loan, and it's a really low underwriting, no income, no credit. I mean, there's all sorts of amazing things about it. No appraisal, and basically, and the funding fee is significantly reduced, even if it's a subsequent loan for you. And basically, it just allows you to reduce your interest rate on your loan and oftentimes save a ton of money. And it's a very quick process. Usually you can get closed in 30 days or less. And it's a fantastic product. And like other refinances, you can finance your closing costs, so you don't have to bring any money to the table.
Yeah. So awesome program. Definitely one of the biggest advantages of having a VA mortgage. So always keep that in mind, that is available to you. And again, you don't want to count on buying a home today with the idea that rates are going to get better in the future. But let's go ahead and get some opinions on here. And again, Gay, this is no pressure, but what do you think near term, maybe the next few weeks, what do you think is happening with rates? Are they volatile? Are they getting better? Are they getting worse? Is it advantageous to lock in? What would your forecast be for the, let's say through the next couple of weeks of October?
Yeah. So, I mean, I think through the next few weeks, I'm full on locking with my clients. It is just not worth risking, what will the rate maybe be tomorrow? And here's why. If I look back kind of historically over the last really almost year, there's very few very few times when I see an improvement where it's a big jump, big improvement where rates like significantly get better in a short period of time. To the flip side, though, I have seen on countless occasions where rates get drastically worse in a very short period of time. And so I am a firm believer that you can only make decisions on what with the information that you have today. And so all my clients, I'm locking. And in most cases, most lenders have the capability to do what's called a float down. And so if we do see one of those situations where rates get significantly better, and they do have to usually improve by at least 0.25%. But usually, if that's the case, then most lenders do allow for some sort of float down. There's some terms and conditions associated with that we won't get into. But bottom line is, I can't go back in time to get a rate yesterday, but I can try to get a better rate tomorrow if rates do improve a bit after I've locked.
Absolutely. And for me, I'm in that same boat. Let's talk a little bit. I'm going to talk a little bit for tomorrow's inflation data. I alluded to that um, earlier in the call, earlier in today's show. So I'm suggesting that you lock because right now the idea is that rates are going to move higher. And tomorrow we're going to get what's called the CPI inflation data. There's actually two reports that are big in the inflation world. The consumer price index is tomorrow. That's the CPI, consumer price index. And then we have the PCE, which is the personal consumption expenditures. The jargon aside, tomorrow's data is our consumer spending. So today we found out wholesale inflation, which did come in higher than even expected. And tomorrow we're going to get that consumer data. Now, if that consumer inflation data comes in showing that the economy still, just running along like a bullet train, the speculation from the markets is going to be that the Fed is going to have to be even more aggressive to rein in this inflation, which means that the Fed would raise rates more aggressively. And right now, as I showed you guys on that chart before, there's a speculation that in November we will see a 3/4 point rate hike. And right now, there's no expectation at all of a full percent, which would bring us to 4.0. Tomorrow, if we get strong inflation data in the morning, specifically what we call core inflation data takes out energy prices and food prices. Now, granted, if you look at where you're spending all your money on today, it's probably energy and food. They've gone up tremendously. But taking those out, we're still expecting to see a lot of inflation tomorrow, year over year, even month over month. And if that happens, we may see traders start speculating that the Fed may do a full 1% increase in November. That's very unlikely, but we'll see. This chart will actually create a new column to the right, and you'll see 4.0. And what that's showing us, though, is it's like a domino. If they expect it to happen, then it's going to happen in November. We're going to go to that December meeting, and the markets are going to start speculating, hey, this 4.25 that right now 60% believe that in December that the Fed funds rate will be at 4.25. Well, we'll see this column drop and we'll see this column go up, and more investors, more traders, markets are going to believe, hey, maybe that 4.5, this goes up to maybe 50 or 60% probability. And as you go farther on, you're going to see the same thing happening as that rate go up. And then I've talked about this before, and I'm just going to touch on it because it is a pretty deep conversation, but we talked before about that, what we call terminal rate. And forgive me, I'm going to scroll through these past notes and we're going to find that terminal rate. I saw it just a minute ago and it was right here. So right now, the Fed funds rate is at 3%. And the idea, we've seen this terminal rate move higher. The expectation was that that's where the Fed is going to stop raising rates and hold steady to try to keep inflation in check. And then what'll happen is the economy, it's going to really start to die. And when that happens, the Fed will then need to stimulate the economy and we'll see them lower rates again. And mortgage rates will also go down around that time. So that's why the expectation of later in the year, and I'll go back to our forecast, the idea in 2023 is that we'll see better mortgage rates come along, but we don't know when. But we do know why. And this is why. So tomorrow we're going to get that inflation data. If it comes in strong and it raises the expectation of how high the Fed is going to raise, they were looking at a terminal rate of 4.6, which I laughed last time and said there's no such thing. It's actually 4.5 or 4.75. But the idea here is that the Fed is going to raise rates more and longer, and we're going to see rates that are going to continue to move higher. So going back to that expectation of, hey, what are we going to see as far as interest rates in the near future? It's more likely that, as disgusting as it sounds, that we're going to see rates that are going to move higher this week, maybe even next week, as we head into that Fed meeting. Then November and December. Gay, do you want to take a stab? I know that you seem like the kind of person that's very much, this is what I've got in front of me. This is what we make our decisions on. But if someone were to say to you, hey, come on, what do you think could happen? Do you have any speculation? Do you think 8% rates could come in November or December? Or do you just think, just keep rolling with it as fast as you can?
Oh man. I if you would ask me this question, even 6 months ago for November, December, especially last year, around this time, a year from now, where I thought rates would be, I would not even guess that they would have been where they are right now. And so, for me to even speculate, I do think that we're going to continue to see increases through November and December. I don't know that 100% that we'll get to the 8%, but I think it's absolutely in the realm of possible.
I'm adding this little ticker here. I'm trying to get fancy with the technology. So I agree, and with the same sentiment that, as recently as just a few months ago, I would have said that we should see rates improving by the end of the year. And right now, though, the expectation is that we will be possibly higher and at best very similar to where we are now. The idea, as we go through grief, basically, and someone is like, hey, it's all perspective, right? Somebody getting a rate of 5.5% when we were coming up from the fours, they would have been like, why are you trying to take advantage of me? I don't want a rate at 5.5%. Oh, that's terrible. Oh, that's horrible. Now that we've got rates in the 6s and the 7s, people are like, could you just get me back some of that 5.5% rate? I would snap that rate right up. I'll take it right now. And that's kind of where we're at is I think the same thing. I don't think we're going to see the economy slow down enough over the next couple of months. If we do see a lack of consumer spending, if we see a tough Christmas and holiday season, spending season, you can tell right now that a lot of the retail stores are actually starting sales. They're calling them Black Friday sales. It's October 12th.
Yeah, I saw that.
And
I saw that the last couple of days.
They're doing it because that's what the markets, what the economists, what the all the pundits, they all think that things are going to slow down, and they're trying to get the money flowing now. And that shows you that we may see that economy slow down. If it does, rates could get a little bit better, but there's a lot that's not lining up for that. We've thought that was going to happen the last quarter, and it didn't happen. So I would say that we're going to see at best rates very similar to where we're at now. And at worst, they would be maybe, up to 0.5% higher, I think is probably the cap if I had to guess. So what about for 2023? Do you think we'll see a recession that rates will eventually drop?
Yeah, I mean, again, going back to if you would have asked me this 6 months ago, I would have said, yeah, I think, late 2022, early 2023, I think we'll start to see rates to get better, rates getting better. But at this point, I think we could be well into mid next year, maybe even the end of next year before we really start to see some significant relief in rates.
Yep, I agree. Based on what we're currently seeing, and again, this could change as the economic conditions change. But right now, it looks like the first quarter we're not going to see much of it, much improvement. It's going to be somewhere like what Gay said. I agree, somewhere in that middle of the year mark, as early as the second quarter, but more likely towards the beginning of that third quarter before we see any significant, retracement in rates. But that can change very quickly, and that's why you have to be, ready to take advantage of those opportunities. But with rates being higher, do you still think it's a great time? And this will be the last question, we'll wrap up, but do you still think it's a good time to buy a house, and why or why not?
Yeah, absolutely. And here's what, if I have clients that are on the fence or like waiting on the market or waiting on this, some people say there's going to be a housing crash, which, we've talked about that many times and why we don't think that's going to happen. But, anytime I hear people like pulling back because of the market, be it rates or housing prices or whatever, I'm like, listen, here's the thing right now, because of rates, because of where they are, there aren't as many buyers on the market. Again, we're not in a, we're not seeing a depreciating market or anything like that, but we're definitely in a buyer's market right now. And so for me, I am telling clients, buy now while you can get in, buy now while you might be the only offer on the house or only competing with maybe one or two other offers. Buy now while you can get seller concessions. Have a mortgage professional do the math for you and show you the cost of waiting. That's a very, very powerful illustration to be able to see how much it actually costs you if you wait by not going ahead and making the purchase. In this case, getting, potentially seller concessions. Yes, the rate is a little bit higher, but the likelihood that it's going to stay that high for the length of the loan is unlikely. And so to me right now is a great time to buy. It's a perfect time to buy, in my opinion.
So I want to throw this out there for other people. If you have in this market, there's still a lot of what we call iBuyers out there, especially a company called Open Door. Open Door bought homes on an algorithm speculation. So if all of you, anybody's ever seen those really terrible Zillow estimates where the computer says, hey, Hammer's house is worth, 1.2 million, whereas Hammer knows his house is actually worth about 800,000. So if an iBuyer like Open Door would come in and say, Hammer, we'll give you that 1.2 million that our computer says your house is worth. And Hammer's like, I'm taking my money and running. And I sell them my house. And what they do is they kind of, sweep the floors, they paint some walls, they make some very minor updates or very minor improvements. And then they would try to sell it usually 10 to 15% premium. In a rising rate environment that we've had in 2021 and 2022, not rising rates, but rising home appreciation, that was working very, very well. They were making money hand over fist. Well, now they have not adapted yet. So if you have an opportunity to get in an offer on a home that is represented by an iBuyer, by Open Door, in fact, my daughter and son-in-law just got a home like that. You can definitely look at getting a lower offer, and you can even ask for concessions after they've accepted your offer. We went back on a $300,000 purchase, and we asked for $20,000 off in home, due to home remedies. We needed some things fixed in the home, and they snap gave it to us. It was amazing to see how quickly they rolled over and just said, yeah, fine, no problem. Because according to their, models, they don't want to be sitting on a home and 3 months from now. And if they let your contract go and they put it back on the market and they wait on it, it's going to cost them that money anyway. So just a little tip, if you are looking to buy, these are some things that may help you around this time. And you can certainly apply that philosophy. You have more power. Like, Gay said, you have so much more power than you did just a few months ago, where we were getting multiple offers and being pushed out. Cash offers also getting a little quieter because investors generally don't want to tie things up when they don't know where the market is going. A cash buyer, it's easy for me to throw a few $100,000 at a house if I think that a year from now it's going to be, worth 10% more, 20% more, which is the appreciation we've been seeing. But if that's not happening, I might not be as quick to throw my cash in. So it now is a fantastic time to buy a home. Remember, if rates do drop, you can always lower that rate and that payment, or at least apply. And again, you can't tell you'll always qualify, but most of the time you're going to. And we're not likely to see a housing crash. We've talked about that before, but we're going to wrap it up. So, okay, anything that you would like to add for today, just for everybody?
Yeah, I mean, just kind of to, really foot stomp my last comment. Now really is a great time to buy. And I'm not saying that, from a business perspective, I'm saying it genuinely. I see so many people trying to sit on the sidelines and see what's going to happen. And where I see a lot of success are those people who are seizing the opportunity right now, getting in a home while, different options are in their favor, really. They'll be able to refinance that loan later, and or get a seller concession to buy down that rate right now, whatever the case may be. But to me, right now is a great time to buy. I mean, me personally, I'm considering an investment property right now, just because I think it's a really great time to buy. Yes, the rates are a little bit higher, but I know I won't be in that rate forever.
Yep. Awesome advice. Well, thank you, Gabe, for joining us. For everybody that's on today's call, let me find my little slide deck here and go back to here we are. So remember, you can join us each week. We do this 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. Gabe, thank you again so much for joining us. Stay on for one moment. I'm going to click end and we'll say goodbye to the live broadcast, but I'll chat with you for a moment. So goodbye, everybody.
Sounds great. Thank you so much. I appreciate it. You guys have a great day.